But we're talking about a business that packages tomatoes to sell to stores and restaurants and stuff. And who knew it? But the tomato packing business is insane from July to October, apparently, right? Like they operate 24 hours a day, and everything's got to be perfect. Everything's got to be airtight. And if they shut down, if they have to shut down the facility for even an hour, all hell breaks loose. And so everything's got to be in perfect working order. Now, they have customers, obviously, customers that purchase a bunch of these, packaged tomatoes. And, the customers, whether or not the facility gets shut down, like those customers expect their shipment of tomatoes or expect to be made whole. And so there's a lot at stake here for this company, right? So what happens is every year they have a credit agreement where a lender loans them money, but that lender says, hey, right, we want to get paid back. So you keep all your facilities in perfect working order. And so at the end of every year, they go out and they engage with other parties that say, hey, starting after the year end, January, February, whatever it may be, you're going to come in, you're going to kick the tires on the whole facility, improve things, deal with the chemicals and the boiler and all that stuff. Basically, get everything ready for the next cycle. Okay? So at the end of the year, let's say now, the end of 2020, they say, we know we're going to, right, incur all these costs to improve our facilities, right? We have a contract with other parties that are going to do this for us, but they're not going to do the work until 2021. We're not going to pay them for it until 2021, but we know it's going to get done, and our credit agreement requires it to get done. And so what they do, right, they accrue the liability on their books, and then their tax people come in and say, we're going to go ahead, right, and deduct that amount because the services are going to be provided shortly after year end. We'll talk about why that matters here in a second. But the question is that proper? Should we be deducting liabilities for services that are going to be provided in the next year? Okay. And so there's a reason we spend hours on this podcast talking about tax law, because it ain't easy, right? I mean, there's just so many moving parts. And something as simple as when can you deduct an accrued liability for an accrual basis taxpayer has spawned so much complexity, right?
Yeah.
So you have to get through 3 tests under 461. And the thing is, the whole point of this case is you got to do them in order. And the first test is one that we largely dismiss and think is a no-brainer. All the events have to have occurred to establish the fact of the liability, okay? So yeah, 461, you got to follow an order, right? Number one, all events have to occur that establish the fact of the liability. And we throw that away. We think it's a no-brainer. If it's on the client's books as a liability, they must know what the liability is. We're going to see that's the crux of this particular case. Now, once we get past that point, then the second test is kind of much easier to satisfy. The liability has to be determined with reasonable accuracy, and there's not a whole lot of meat to that. It's the third one where we pay all of our attention. It's the third one that made that article I wrote for Forbes useful to people, is you can't deduct the liability until economic performance has occurred. And those rules are under 461-4 regs and -5 regs, and economic performance occurs at different times for all different types of liabilities, whether it's interest or rent or services to be provided to you or goods to be provided to you, and then taxes and insurance and rebates. There's all different rules for all different types of liabilities. And so we spend all of our time when we prepare a return, and I guarantee, a bunch of your listeners out there are young in their career. They've been for a couple of years now asking questions of, well, when was this accrued vacation paid after year end? Or when was this accrued rebate paid after year end? And they may not even know it, but what they're really asking there is, right, did economic performance occur? And there's a decent chance they may not even be asking the right questions, which is kind of what that article was getting at, is it all depends on the nature of the liability you're looking at.
It's confusing. And that's why I think that, again, back to that article, man, I mean, you laid it out there in a way that really helps to unpack it, because it is for some reason it's just hard to keep track of.
It is. It needs to be laid out because the rules are so different. I mean, It's not even all 461. You get kicked over to 404 for deferred comp type items. But what I love about this case is it says, hey, before you worry about economic performance, we got test number one to deal with, right? Have all events occurred that establish the fact of the liability, right? And here, we always want to keep touch with its revenue ruling 80-230, but it says, when is a liability fixed? When have all events occurred that establish a liability? It occurs when the earlier of two things happen, right? Either the other party has performed their obligation under the contract, or payment is due. So think about what I'm saying there, right? This client, this taxpayer, this tomato packager, at the end of 2020, they would have accrued a liability for services that are going to be provided in the next year, and they've signed a contract. The thing is, right, no payment is due under that contract until later. And so we would not, in the tax world, even blink an eye at this liability. But the fact is, it's a problem. And it's a problem because we have, Revenue Ruling 2007-3 made pretty darn clear to us that merely executing a contract does not mean the liability is fixed. If at the end of the year, the services haven't been provided or the amount isn't due, you don't have a good liability, right? And so think about kind of what that means. Like, if the other party had performed the services, we just didn't pay for it until next year, we'd be able to deduct this liability for the tomato packager. Or if the amount was due under the contract, maybe we just didn't pay it yet, but it was due and we paid in January, we'd be able to deduct that liability. But in this case here, we're putting the cart before the horse because there's no good liability, because the services to repair the facility they're not going to happen until the next year, and the amount wasn't due under the contract until the next year. So they made a pretty fun argument, the taxpayer. They said, well, wait a minute, you're looking at my contracts with the people that are going to provide the services, and that didn't fix the liability. But you know what fixes our liability? Our credit arrangement. Our credit arrangement requires us to do these services every year, or else we're going to lose our credit. And so that's what's fixing our liabilities. And the court just said, look, we looked at your credit agreements and they're vague. They say, yeah, you have to keep your facilities maintained, but they don't say when. They don't say to what degree. And so there's nothing we're seeing that establishes the fact of this liability by year end. And so asking, how soon is it going to be paid after year end? Or actually the appropriate question would be, when will the services be provided after year end? None of that matters if you don't have a good liability. And so here we didn't have a good liability. So the big takeaways from that case are, there's a process under 461. Before you drive yourself crazy with economic performance, and you will, make sure the liability has been fixed. And what we learned in that case is merely executing a contract, like they said in Rev Ruling 2007-3, that doesn't get the job done, right? For the liability to be fixed, you have to either, right, have the services and goods provided under the contract by year end, or payment has to be due before year end, okay? So I love that case because I always like when we go chasing down one path, and every now and then the IRS reminds us, like, you don't even get to start down that path until you do this first.